Hola, buenos días. ¿Me escuchan?
Hola Andrea, buenos días. Sí, te escuchamos. Dime, ¿qué estás haciendo?
Hola, buenos días a todos. ¿Qué tal?
Perfecto. Hola,
Hola
Feli,
Feli,
buen
buen
día.
día.
Hola, André, buenos días.
Good morning, dear attendees joining us from different parts of the world. Welcome to this new Flar's dialogue session that has been entitled External Accounts of Partially Dollarized Economies in Latin America, the Perspective of Central Bank Technical Staff, held by Flar. Today, we are going to have representatives from Paraguay, Uruguay, Dominican Republic, and Costa Rica. We are delighted to have the following panelists who are in charge of 4 central banks in the region and who are responsible for external accounts. So we will learn about their viewpoints. These are technicians responsible for analyzing current accounts and financial accounts in partially dollarized economies. That is to say, those that face other instruments apart from traditional ones. So we are closing 2026, and in a global context that is marked by geopolitical tensions and the different dynamics, we would like to learn about the greater selectivity episodes of volatility and shifts in investor risk appetite. So we would like to thank Brenda Villanueva from the Central Bank of the Dominican Republic, Maria Rosa Ortellado from the Central Bank of Paraguay, and Ms. Colombo from the Central Bank of Uruguay. So today we're going to have a round of interventions by each panelist, followed by questions that we have received during the registration process. So we're going to start with the first round. We are going to hear each panelist to talk about recent evolution of external accounts in each country and their view with respect to how they perform in the current context. We are going to start out with Brenda Villanueva, who is Deputy Manager in charge of the Directorate of the International Department at the Central Bank of the Dominican Republic. She holds a business administration with a past graduate degree in corporate finance. Besides, she has a specialization in applied macroeconomics. Thank you for joining us today, Brenda. We are delighted to have you. You have the floor. Thank you very much. And thank you very much for this invitation to participate at this webinar. Okay, so let me start by walking you through 2025 key results. In the case of the Dominican Republic, the external sector performed very well in the Dominican Republic, despite the issues arising from tariffs. Exports were supposed to be affected by tariffs, and that was the case, growing only by 0.6%. However, the country performed quite well and it grew. On the other hand, gold also helped us. Exports also grew by 6.6%. Gold price was high, and we were able to take advantage of that. The Pueblo Viejo Mining Company was able to improve its output. As a result, we were able to report increased gold production, and we also were able to take advantage of the increased price of gold. As for tourism, even though it had fallen a little bit compared to 2024, we were able to reach more than 11 million euros in tourism, which also had a positive impact on the current account. As for remittances last year, they also grew considerably. We were able to obtain 11.866.3 billion euros, therefore growing by 9.3% year on year. FDI was also higher. We were able to post a growth of 11.3% in the case of foreign direct investment. So this is the breakdown by country and sectors. The United States continues to be a significant country for our economy, with 44.1% of exports last year going to the United States, 16% going to the rest of the Americas, 11.4% going to Haiti, which is our second commercial or trade partner after the United States, which is also something worth highlighting. And then we have incoming remittances. The United States also plays an important role, with 81.5% of incoming remittances last year came from the United States. That's why whatever happens in the US economy has a direct impact on the external side of the Dominican Republic. Also, here we can see other countries that played an important role in terms of incoming remittances. From FDI perspective, the most important economic activity is tourism, accounting for 26.9%, followed by energy that accounts for 24.4%. This is mainly concerned with renewable energies, which played a very important role in the economy of our country. As for passenger inflows, the United States also has a significant share, accounting for 46.5% of passengers coming to the country came from the United States, followed by passengers from Canada. So in terms of passenger flows, we're also quite dependent on the United States. As for the 2026 outlook, what do we expect? Well, this graph shows what has happened during the first 2 months of 2026 in terms of total exports to February. We were able to post exports by 22.3%. As for national exports, 43.7%. As for free trade exports, you can see that there was also a 7.2% percentage. January and February, if we add up these 2 months, we count to 1%. And we have weekly data as for incoming remittances. In March, we expect remittances to grow because that has been the trend over the past months. There has been a deceleration, however, the fall has not been so drastic as one could expect. As for incoming passengers, they went up by 11.3% in March. What do we expect going forward in 2026? 2025 resulted in lower current account deficit. We closed at 1.2% over GDP. And as for 2026, we expect a current account deficit of around minus 1.8% given the current circumstances or in the current context. So that is our estimated current account deficit. That 1.8% is grounded on the following projections. We expect total exports to grow mainly as a result of gold at 9.1%, even though the price is no longer 5,000 right now. The price is 4,500 troy ounces. So we believe that the price will be around 4,400. Regarding tourism, we believe that we are going to grow a little bit less. We are conservative given the current circumstances, so we expect to grow by 2.1%. Regarding remittances, we believe that growth will also decelerate. On the one hand, there is a 1% tax levied on remittances, and on the other hand, the U.S. job market underperformed over the past months. Therefore, we also expect a deceleration compared to the prior year. Regarding FDI, we believe that new investment will continue to come into the country. We have some data concerning tourism and energy-related projects. On this basis, we believe that FDI will reach or will somehow reach 147 million euros, therefore offsetting the current account deficit. From the exchange market performance perspective, there has been an appreciation as at February, standing at 5.2% on an aggregate basis compared to the closing data back in 2025. On an international basis, the figure was 3.9 in February, and from a international research perspective, we were able to reach quite significant levels. We closed February at $16.181 billion, 5.7 months of exports, or 12.2% over GDP. All these levels are in line with the recommendations by the IMF. If we analyze other metrics, and if we take into account international reserves, according to the IMF, 127 of reserves are in line with flexibility approach recommended by the IMF. So our current reserves level is quite adequate and somehow insulates us in the current international crisis, where the foreign exchange rate happens to be stable. Therefore, this 1.8% that I mentioned before is based on the gold price of 4,400. This is, some analysts believe that oil prices might continue to go down. However, should it remain at 100, well, the current account deficit might be 2.5, which would still be below the 3.5% current account deficit, which has been our historical figure. Even though there is a lot of uncertainty to date, we believe that the external sector in the Dominican Republic stands quite strong. That's all. If you have any questions, I will be glad to address any questions. Thank you very much. Thank you very much, Brenda. In the case of the Dominican Republic, the presentation shows the key role played by foreign exchange generators such as remittances, exports, tourism, as well as FDI in order to support external balance. It shows some relevant recent aspects such as gold appreciation, the dynamic tourism sector, the importance of the renewable energy sector against an uncertain international landscape. Therefore, we had to consider the outlook for 2026. Therefore, some conservative approach is being taken in order to address future challenges, in order to keep external stability. Next, I would like to give the floor to Maria Rosa Ortellano, the Director of External Sector Statistics Department at the Central Bank of Uruguay, where she filled in different leadership and technical positions, gathering statistical data. Before that, she worked for on industrial competitiveness. She has a master's degree in international finance and economics, so we are delighted to have you. Maria Rosa, please go ahead. Good morning, everybody. I would like to thank Flar for having me to participate at this webinar and for allowing me to share my insights about our recent experience in Paraguay concerning external accounts. I'm going to talk about recent performance of financial accounts and the external position of the country, as well as the country's current account. This presentation is based on 5 sections: the evolution of current account and financial accounts, followed by the components of current accounts with an emphasis on the assets account, also the international investment position and the external liabilities composition. And finally, I'm going to talk about external resilience and some additional insights. This graph shows the evolution of current account and the financial account of Paraguay. Here you can see some swings and with some ups and downs in terms of current account deficits. Over the past years, especially after the pandemic, there was some deficit recurrence that happened mainly in 2020 to 24 and 2025. Such deficit required external financing, and that had an impact on the financial account of the country. This graph shows Paraguay's current account composition in terms of percentage over GDP. Not all components behave similarly. Some of them show a more stable trajectory compared to others that somehow account for swings in current account balances. We can highlight primary inflows that shows some persistent behavior across the series. This has to do with FDI, which accounts for 4% over GDP on average. As for secondary revenue, we can see a relatively stable surplus that is mainly related to incoming remittances. As for services, going forward, this could account for significant contribution fostered by service exports, as well as transactional validation. However, in the case of the goods account, here we have the greatest number of fluctuations, and this accounts for the dynamics of the current account of the country. If we now focus on this account, there is a clear link between surplus-based episodes and deficits throughout the period. As for surpluses, as the ones posted back in 2013, 2017 or 2020, they were all associated to increased exports or moderate exports against a more favorable context in terms of international prices. 2022, 2024, and 2025 deficits were due mainly to droughts, lower export product prices, and the higher price of imports, particularly fuels, as well as the import of capital goods. If we are to better understand these dynamics, I'm going to now explain the composition of trade and the evolution of some key international prices. This graph addresses two structural components behind the current account. On the one hand, trade composition and the evolution of some key international prices. Here we can see that the account concerning goods continues to be tied to international prices, while showing, however, more diversity compared to the start of the period. On the export side, there was an increased share of farming and manufacturing products. As for energy and electricity, somehow fall in terms of their weight. Then we see increased weight of capital goods and a lower share of intermediate products, particularly fuels. Now, this increased diversification do not overlook other aspects such as adverse events, such as natural events, and this also has an impact on international prices. we should observe the price of soy since 2022 that has led to a less favorable context for the goods account. In the case of bovine meat prices, well, they were able to offset the prior reduction. Yeah, we can see some significant sensitivity that has to do with trade composition that somehow enable us to offset these shocks. If we now take a look at the financial account, it is quite clear that Paraguay has been bringing together different external financing sources throughout time. Depending on the point in time, there has been investment in portfolios, FDI, as well as assets in store. FDI has been more regular compared to the rest of the components. Now, as for portfolio investments, as well as the variation of reserve assets, fluctuated more markedly in certain years. This chart therefore shows that external financing has been channeled through different sources, even though FDI continues to be particularly relevant since it is more stable and since it can be guaranteed in the long term. If we now take into account the international position of the country throughout this period, the Paraguay had a net debtor position vis-a-vis other countries. However, there was no continuous deterioration, but rather a relatively stable position with some fluctuations that move at the same pace as current account performance. When the current account improves, as it happened back in 2016, 2017, that fluctuation moderated. In adverse circumstances, the current account deficit was accompanied by a greater deterioration of the external position. This chart therefore shows that Paraguay remained a net debtor, but with a relatively stable trajectory that was consistent with current account performance. If we now take a look at external liabilities composition, we can observe that they have changed over time. At the beginning of this period, loans were very important on external liabilities. That share afterwards came down, whereas FDI began to be more important. Recent years, there was also investment in portfolios that was related to sovereign issuances. Therefore, composition is right now much more diversified in terms of external liabilities when compared to the beginning of this period. This chart shows that Paraguay's external debt maturity schedule is quite long over time, and it's mainly denominated in foreign currency. Over the past years, however, we have also observed some gradual improvement in terms of external financing denominated in home currency, therefore reducing the foreign exchange risk accordingly. All in all, there has been a more solid debt structure, even though this position continues to be something we have to pay attention to closely. And in closing, let me share this chart that contains some key takeaway messages. Well, Paraguay continues to be tied to some climate shocks as a result of global conditions and energy prices. However, we can also see some aspects that enable us to moderate this position. On the export side, the structure is much more diversified with some activities that are not so tied to sensitive climate conditions. On the import side, there is a lower relative price of fuels and a greater share of capital goods. As a result, sensitivity to international oil prices can be reduced. Then we also see a better balance between external liabilities and assets with more participation in terms of foreign direct investment and a lower role As for loans, we also observe some gradual progress. As for external financing in home currency, all in all, we can say that this economy continues to be exposed to external shocks. However, it has been building some resilience components when it comes to both trade and financing. I therefore finish my presentation now. Thank you very much for your attention. Thank you very much, Rosa, for such an interesting presentation about Paraguay. Let me highlight that there has been increased current account deficit recurrence after the pandemic. This has been financed through the financial account as well as a deficit weight in the case of primary revenue in the face of some stability thanks to remittances and services, even though as for goods accounts, it has been marked by international prices, climate events, the fall in soybean prices, and therefore this shows the external challenges that Paraguay is facing. Against this context, Paraguay now has a more diversified structure with more balanced financing, and therefore now the country can face the current context in much better shape. Now we are going to continue with Rigoberto Torres, the Director of the Organizational Data Analysis Department at the Central Bank of Costa Rica. He holds a PhD in Economic and Business Sciences and a bachelor's degree in Economic Sciences. He has held key roles in macroeconomic statistics and international consultancy, and he has prepared different economic policies. Apart from this position, he's also a director of the School of Economics at Universidad Latina de Costa Rica. Thank you very much, Rigoberto, for joining us today. You have the floor now. Thank you very much. I'm delighted to be here, and I appreciate this invitation by Flar to participate at this dialogue. Could you please confirm that you can see the presentation now? Yes, we can. Thank you very much. Okay, so let me walk you through the general characteristics of Costa Rica. Costa Rica is a small, open economy from an economic and financial perspective with 5.2 million people, with GDP standing at $102.905 million US dollars, with a GDP per capita standing at 19,824, according to the BM, with a country risk that stands at 155, below that of other Latin American countries, showing some improvement over the past years, and a total public debt that stands at 60.4. The country is also quite open in commercial terms, and from a financial perspective, Costa Rica has also been improving its investments from a monetary policy perspective. It tries to control inflation with floating exchange rate schemes. As for foreign currency share, there has been a decrease since 2020, and it has stabilized at around 1/3 of the aggregate. Taking into account that the country is a dollarized economy, or de facto, but this is the current currency policy the country has. From a macroeconomic stability perspective, here you can see some of the selected indicators. The country has grown by 4.6%, which is quite close to its potential capacity. The employment rate stood at 51.4% in 2025. The unemployment rate stood at 6.6% in 2025. In 2024, headline inflation stood at 0.8%, and in 2025, -1.2%. The internal public debt stood at 43.2% in 2024 against 44.3%, showing some internal stability. From an external perspective, there was an external or a current account deficit standing at 0.7% in 2025, with FDI on the liability side standing at 5.4 in 2025, somehow offsetting current account deficit. Therefore, net international reserves stood at 14.7% in 2024 and 16.6% in 2025. From a reserve indicator perspective, we are above the recommended limit, standing at 147.3 in 2025, which shows that we stand strong in the face of any adverse events. The current account deficit has been coming down significantly. In 2024, it stood at 48.2%, by contrast with 45.6% in 2025. External public debt stabilized at 16.1%. On in all, we see that the external sector, when coupled with the internal sector, point to macroeconomic stability that is deemed reasonable for the past years. The following slide shows the breakdown of inputs and exports, taking into account goods and services. This is a balance sheet that corresponds to goods. Exports have been climbing mainly due to the sale of medical devices. This is part of the production that takes place in some free trade areas in the country. This has been coupled with increased service exports. In this case, we can highlight other business services. This is quite significant because this item already outperforms travels, showing how the country's export structure is shifting, as also shown by foreign exchange stability. These service exports have led to stable surpluses over time, and as for or since 2015, this has caused the country's trade balance to post a positive figure, showing that the country's export structure has shifted, and this, of course, has an effect on production. Regarding exports, whether we talk about goods or services, special regimes play a key role. In 2025, 68% of goods exports fell under this regime. That is to say, they corresponded to free trade areas. The main destination being the United States, followed by Europe and then Central America. As for services, these are mainly managed by companies that also adhere to this special regime and who account for about 95%, and who are also FDI recipients. And this shows the exports and imports in Costa Rica and how they have grown over the past few years. Okay, let me now walk you through the service exports breakdown. 43%, and this number corresponds to 2025. ICTs that are normally sold over platforms This accounts for 43% over total service exports. This therefore constitutes how resilient the Costa Rica's economy now is, because these exports even grew by 5% during the pandemic. Other services also account for a significant contribution. However, now we are highlighting how important service exports are for the country. Let's now take a look at the export sector from the balance of payments perspective. Current account continued to fall, standing at minus 0.7% in 2025. Which was the reason behind this downward trend? Well, the trade balance stood at 8.1%, and as I said before, services and goods also grew in 2025. As a result, primary revenue in a country that imports capital through FDI was negative, and this accounts for this current account figure. However, part of this primary revenue is reinvested as shown here in this figure that corresponds to direct investment, which remained stable over time. And this is connected to gross liabilities. About 5% is used in order to finance 5 times the current account deficit. As a result, we were able to increase reserve assets from this figure of 8.8% to almost 16% between 2020 and 2025. As for the outlook going forward, we should adjust these forecasts given the current episode that we are addressing in the geopolitical context, causing hydrocarbon prices to climb. This might lead to an increased deficit that might stand at 2%. It will all depend on how long this episode lasts. Nonetheless, prior to this event that has worsened over the past few weeks, world growth has stabilized at 3.2% approximately, with commercial partners standing at 2.2%, and Costa Rica is expected to grow at a rate of 3.8%. We believe that we could even go beyond this figure, and we could perform more than expected if tourism and other economic activities are pushed further. The current account deficit continues to be subject to financing. This is the goods account deficit that we estimate would stand between 2.2% or 2.5%, depending on oil prices going forward, and then service surpluses that might stand at 9.5%. As for direct investment, we believe that we are going to record 5.2%. And as for net international reserves, they are expected to remain at a level that might be sufficient to address the current external shocks. The country's GDP is now sufficient in order to tackle these adverse external shocks, and we believe that they will not penalize the external stability that we have been able to report over the past few years. Now, let me point out some highlights. First, relative participation in terms of foreign currency. As for financial wealth and the private sector credit, which has come down, we have some internal external indicators that may lead us to conclude that Costa Rica's macroeconomic performance will be solid. We believe that we will be able to address any external shocks, and noteworthy is the sustainable reduction of goods deficits as a result of the sale of medical devices. Also, good performance of services. Here we have been able to export ICTs with a very good result. This is an element that we should underscore because this accounts for the structural changes affecting the Costa Rica's economy. As a result, current account deficit has fallen well beyond the 3.5%, 4% that was our historical percentage. We have also been able to stabilize FDI not only thanks to new inflows of revenue. And all this has enabled the country to strengthen its financial shield, reaching an IR that is close to the ceiling of 150, which is the recommended percentage for the countries such as Costa Rica. So despite the current global geopolitical context, we believe that the country stands strong in order to address all these external shocks without affecting its external stability while maintaining a macroeconomic stability that might enable us to continue having relatively stable financial inflows, as it has been the case over the past few years. Thank you very much, and I'm delighted to be here. We'll be glad to answer any questions subsequently. Thank you very much for your presentation, Rigoberta. Costa Rica's situation is very interesting because it shows a solid position with a current account deficit that has been sliding down over the few past years, bolstered by strong international reserves. He spoke about the transformation of Costa Rica's export composition, with goods and services being more dynamic, where business revenue has already surpassed travel, supported mainly by special regimes. So the combination of FDI with a diversified export structure with surpluses and adequate financing position the country positively in order to face current external shocks. Thank you very much. Next, we are going to have Maria Fernandez Colomba, who is the head of Foreign Sector Department of the Central Bank of Uruguay. She holds a degree in economics and a master's degree in international economics by Universidad de la República. She's also an accountant, and she has over 15 years of experience under her belt working at the Central Bank of Uruguay. So we are delighted to have you here, Maria Fernanda. Thank you very much for this invitation. And now let me share my screen. First off, I'm going to walk you through the characteristics of the economy of Uruguay. Next, I'm going to talk about Uruguay's current account and financial account evolution. Next, I'm going to share with you some short-term perspectives that can affect our current account. And then I'm going to talk about international investment position. As for our economy, as you know, Uruguay is mainly a commodity exporter. About 60% of exports consist of meat, dairy products, soy, and rice, as well as cellulose. And we import machinery, automobiles, oil, and petrochemicals that are mainly used in the agricultural sector. We are also a free trade zone country where companies can get special tax exemptions. There are no restrictions for incoming or outgoing foreign currencies. Therefore, the country is a very important recipient of foreign direct investment, where a lot of trading activity takes place. From a macro perspective, the country's GDP stood at 1.8% in 2025, with the inflation rate standing at 3.11%, which is within the range established by the Central Bank of Uruguay. As for the current account and financial account evolution, the graph shows both accounts through the red and blue lines. There was a deficit in 2025 showing therefore why we need external financing. There are some exceptions, such as what happened in 2016 and 2018 when the economy accelerated with domestic demand dropping, also causing imports to drop quite significantly. In 2019, there was a widespread fall in imports as a result of a strong appreciation of the Uruguayan peso, and also due to the global economy's deceleration. And this also has to do with primary revenue coming from companies operating in the country. Right now, our current account shows a deficit, 936 million dollars, being the deficit of the financial current account. We do not yet have all the data necessary from the private sector in order to disclose the final data. We do not have the annual financial statements ready yet. We normally use this information in order to disclose annual data. The next slide shows the evolution of the current account and the financial account broken down by SCC. The current account deficit over the period has reported these figures. I would like to highlight that back in 2021 and 2022, the balance of payment was also reported a deficit in terms of services. That was the period of the COVID-19 pandemic. We were affected by the drop in the tourism sector. In 2024, we were also affected given the fact that tourism prices in Argentina were more favorable. We also had some effects coming from primary revenue due to FDI. And all these affected, therefore, the balance of the current account in Uruguay. These are the financial account or the financial account deficit. This is the current account balance. Usually Uruguay has to resort to external financing. If we analyze the period between 2022 and 2025, Uruguay has obtained foreign financing. And Uruguay has also been acquiring financing through the acquisition of bonds issued by other countries. This shows the evolution of the public sector and the private sector in terms of financing. The public sector, as I said before, has been financed through bond issuances, as well as by resorting to international bodies. As a result, reserves could be accumulated. As for the private sector, financing has been obtained mainly through FDI. Very often when foreign companies come to do business in the country, they do not use their own resources, but rather they resort to financing. The private sector has also financed itself through external financing. In Uruguay, FDI and capital inflows have always been positive. Also, the country is characterized by companies distributing their profits with their parent companies. So in summary, Uruguay receives external financing through FDI for the private sector. The same happens with the public sector. Public sector receives financing through the investment in portfolios. As for short-term projections for the current account, we are currently monitoring some variables that we find particularly important on the current account side. For example, the evolution of the foreign exchange rate. We also pay close attention to the price of commodities. We also expect some large FDI projects to come to Uruguay with large capital investments being made. All these, therefore, translating into a current account surplus. We have also observed some business relocation or companies coming to Uruguay in order to relocate their businesses. And we are also paying close attention to Europe and Mercosur agreement. This is Uruguay's international investment position. At December 2025, there was a debtor balance standing at $31.730 billion. At 6.65 billion in the case, in this other case, here we're talking about direct investment. In 2022, this balance was reversed due to the issuance of external debt in the private sector. If we break this down by sector, we can see the different balances in the public and the private sector. We can also see the accumulation of reserves. These are the liabilities in the public sector. This is the private sector's debtor balance standing at $20.129 billion US dollars. This corresponds to direct investment. Here you can see the different figures. Thank you very much. Thank you once again for having me. I hope I have been clear in my presentation. And here you can see my contact details should you need any further information about Uruguay. Thank you very much. Thank you very much, Maria Fernanda, for your presentation. It's been very clear. You have shown how important it is to analyze external accounts. You have also shared with us this comprehensive breakdown considering the public and the private sectors respectively. The last slide shows the international position and how the private sector had a positive conduct, somehow offsetting the deficit reported in the public sector over the past few years. Current account and external financing conditions also performed in a highly uncertain international context. Thank you very much, Maria Fernanda. Well, we therefore come to an end to the presentation of each panelist. Thank you very much. They have all shared their technical viewpoint about the challenges posed by external accounts in the current global high volatility context. We're going to start with the Q&A now. We're going to address one question to each panelist, and we're going to close with a general question. Brenda, let me start with you. Taking into account the structure of the economy in your country, where tourism, FDI and remittances are key, how do you assess the vulnerability of the external sector, taking into account the international financial conditions and the current episodes? Well, as I mentioned before, the Dominican Republic, in the face of international uncertainty, we are in quite a strong position right now, even though, as I said before, we depend on remittances and on tourism. FDI in the Dominican Republic finances over 100% of our current account deficit, and that has been the case over time. Even during the COVID-19 pandemic, at first, we thought that FDI was going to fall by around 45%, but eventually it fell by only 15%. Therefore, we understand that we have a good foreign exchange right now that is flexible enough, that is in line with macroeconomic fundamentals, and therefore we can absorb all these shocks. On the other hand, even though we are being affected by high oil prices, the energy matrix of the Dominican Republic no longer relies so much on fuel. Therefore, we're now less vulnerable. Back in 2000, fuel oil accounted for 90% of our energy stock. Right now, it accounts for only 14%. Therefore, we have much more renewable energy. We have coal, we have other sources of energy that make us less dependent on oil, and then gold, which remains a store of value in times of uncertainty, especially now that stands at $4,500 on ounces a troy. In 2027, we are going to extend the current exploitation of our mining until 2036. Therefore, gold will continue to be a source of financing. So despite financing rates externally being high, the Dominican Republic has been able to obtain good financing rates. Our country risk right now is lower compared to other peers in Latin America. So all that provides us with a favorable context. Thank you very much, Brenda, for answering this question. Now, Maria Rosa, we would like to learn more about Paraguay. So let me ask you the following. In the current global uncertain context, how has Paraguay faced the climate events and commodity prices shocks, and how have all these developments affected your current account deficit? Well, in the case of Paraguay, commodity price volatility and climate shocks have affected our goods account mainly. And this is mainly reflected in exports. Usually droughts reduce the value of our exports. Shortage of electricity also has a negative impact on exports, and therefore the goods balance is deteriorated. Back in 2012, 2019, or 2022, that effect turned out to be quite clear. As for international prices, the same applies. If the price of soy or its byproducts go down, export values also go down accordingly. And in the case of imports, if oil prices go up, the price of imported fuel also goes up with an impact on the goods account. Eventually, these shocks normally have a pass-through effect on the goods account, which has a particular weight on Paraguay's current account, mainly because primary revenue has also been reporting persistent fluctuations. And as for adjustment mechanisms, we have three. On the one hand, the adjustment of the goods account. Here we can see the effect of reporting lower imports or a combination of imports and exports. Foreign exchange is flexible. In this case, it has a role of a buffer. Next, external financing through the financial account. And this is what normally happens when current account requires external financing. And the third structural component has to do with the fact that the economy has been factoring in some elements as a result of which such shocks have been offset. For example, a more diversified export basket and external liabilities with a composition that was more balanced compared to 2008. So in a nutshell, Paraguay continues to be exposed to these external shocks. However, now the country has some adjustment mechanisms and some resilience elements that can be used in order to offset the impact that this can all have on the country's current account. Thank you very much, Maria Rosa, for your answer. Next, Rigoberto, this question is for you. Rigoberto, could you please give us more color on how FDI inflows affected financial account performance and external resilience in the country? Thank you very much for the question. Andrea. In the case of Costa Rica, FDI constitutes the main source of external financing in order to finance current account deficit. This has been about 5.2% on average over the past 3 years, and this FDI accounts for 70% of liabilities we hold with the rest of the world. First off, therefore, this is a financing source to finance our current account deficit. Second, it has helped us to push export diversification and output diversification. Exports in the country are recipients of a high share of FDI, and it has also contributed to increased productivity in the country. As a result, the country's foreign exchange rate has remained stable over time, and it has also fostered job creation. Right now, companies in Costa Rica pay salaries quite well above other peers. Knowledge transfer has also been significant, and it has also contributed to a stable macroeconomic context to seize more FDI. We understand that we have to remain on track, and we have to continue bringing together the public and the economic policies together. This therefore fosters job creation, know-how transfer, and this has contributed to Costa Rica's structural change, which was first experienced in the early 20th century. Thank you very much, Rigoberto, for sharing with us the key role played by FDI in Costa Rica. Maria Fernanda, now I would like to deep dive into the methodology that you shared with us during your presentation. So here's the question. As for special purpose companies, how are they statistically treated in the context of international accounts? Could you please let us know how they are classified from a statistical perspective? Thank you very much for your question. As I mentioned before, there are many companies in Uruguay that have an important impact on the financial account of the country. Some of these companies may have significant liabilities in terms of FDI, and therefore that has not have an effect on the balance of financial account. If analysts look into this data, they prefer to have a breakdown of all the statistical data in order to understand when FDI is used for production activities. Very often they realize that certain liabilities are being used in order to finance other assets within the group. We have a work plan in place. We're now drafting some new manuals. And we foresee to start reporting statistics separately in order to identify the different phenomena on a separate basis. There are many companies that are engaged in sale and purchase transactions, but we're still lacking all the data concerning these companies. So we would like to deep dive into that further. We do have some internal analysis from a balance of payment perspective. We therefore need more data and in order to complement the information. Well, thank you very much for explaining the methodology further. Well, since we are about to finish, let me just share one more insight with you. This is for Brenda, Maria Rosa, Brigoberta, in order to get a comparative insight. So here's the question. In the current geopolitical context, do you spot any risks to external sustainability, taking into account current account pressure, capital flow, volatility, external financial fluctuations, and what kind of policy could be used to put in place in order to tackle such a context? Well, this question is very similar to the previous question that you addressed to me. I said that right now we are particularly exposed to oil prices. There are other prices, other risks such as climate risk, for example, hurricane events, or that also has an impact on the country. Then gold, however, provides us with some backup or a buffer in order to sort of offset the impact coming from high oil prices. And external financing is another aspect. The country has been able to obtain financing at very competitive rates. We have major FDI that has proven to be resilient and has remained at 4 billion over the past years. Last year, we received 5 billion. This year, we expect an equal amount, and all that will be used to finance the current account. From a policy perspective, we have specific inflation targets in place. The inflation we have reported has been within the band, that is to say 4.1%, which is another important aspect. The foreign exchange rate is also well balanced and in line with its fundamentals. It has been depreciated as of late, and as a result, we're now very competitive in the current uncertain context, and it also enables us to tackle external shocks. We have high international reserves in place, and all that, despite the current global uncertainty, finds us in a resilient position in order to address any potential shocks. Thank you very much, Maria Rosa. Your turn. Thank you, Andrea. I would say that the most important risk today is due to high oil prices, because that has a direct impact on prices in Paraguay and therefore on the country's current account. Well, that could also lead to a downturn in exports that might also be coupled with climate developments, and therefore that can have a significant effect. On the financial side, inflows might be more selective and financial conditions or financing conditions might be tightened. Now, Paraguay, however, has put in place some significant buffers. During my presentation, I described a more balanced liabilities composition. The foreign exchange rate continues to be a first line of defense for the country, with the right reserves stock and good external financing conditions. So our policy making response has to do with maintaining the current foreign exchange policy, maintaining reserves, and keeping prudent external financing conditions. Thank you very much, Maria Rosa. Rigoberto, your turn. Thank you. Well, the first impact we should highlight is the high price of hydrocarbons that can have an impact on current account deficit. However, we are standing in a strong or solid macroeconomic position with good international reserves. From a more holistic perspective, I believe that authorities should continue to take actions in order to reinforce public finance They should also continue to diversify the economy, increasing therefore knowledge-based service exports, or actually striking a better balance on the export matrix. As for the monetary policy perspective, the country should also have a clear-cut inflation rate target within the band, or take any other actions that have to do with our macroeconomic framework. And we should continue to adapt ourselves to climate change. As Brenda pointed out during her presentation, we should be less dependent on crude in order to therefore strike a better balance in terms of our energy matrix. I therefore believe that regardless of any external shocks, countries should continue to reinforce their macroeconomic stability and therefore be prepared to address any such events that might be difficult to handle by countries like ours. Well, thank you very much for your final remarks. This has been a very positive dialogue. Unfortunately, we have come to an end of this webinar. Thank you very much for your excellent presentations and for sharing such a deep analysis on these strategic topics concerning our region. We would also like to thank our attendees, and we look forward to sharing another webinar with you in the near future. Thank you very much.